September 2008, a bank older than the telephone, 158 years old, disappears in a single weekend. Almost 8 million jobs wiped out, $19 trillion of people's savings simply gone. But here's the part nobody tells you. The thing that took down the entire world economy wasn't an evil genius. It wasn't a natural disaster. It wasn't some hacker in a basement. It was a house. A boring, ordinary house, one a lot like the one you're hoping to buy someday. And the reason you still can't afford that house today, it starts right here. Let me draw it small enough to see. To see how it all started, we have to rewind to the early 2000s. Back then, the economy had just face-planted twice. The dot-com bust, then the shock of 2001. And the people in charge of money had one big idea to fix it: make money cheap. Quick napkin term, the interest rate is just the price of borrowing money. Turn it down and borrowing gets cheap. They turned it way, way down. Money went on the deepest sale you have ever seen. The kind of sale that makes you put things in your cart you never needed. And when borrowing is nearly free, everyone goes looking for something safe to pour that cheap money into, something that only ever goes up. Everyone knew what that was. Buy now. Property only ever goes up. Safest bet there is. Hold on to that sentence. Houses always go up. Every single person in this story believed it. That belief is the foundation everything else gets built on. Pull it out, and the whole stack comes down. Let's step back for a second and get the basics out of the way. To buy a house, you borrow from a bank. That loan is called a mortgage, and the deal is simple. The bank fronts the money, you pay it back slowly for 30 years, and if you stop paying, the bank takes the house. So the house is the bank's safety net. Stop paying, and they're covered. Honestly, it all sounds a little boring, and that is exactly where it starts to get weird. The banks handed mortgages to everyone who could obviously pay. Then they ran out of those people, but the cheap money kept flowing, and Wall Street kept wanting more loans. So the banks made a decision: lend to the people who couldn't pay. No job, no income, no savings, no problem. Zero down. Sign right here. These had a nickname on Wall Street: ninja loans. No income, no job, no assets. And slang aside, these loans had an official name too, and this is the one to write on your napkin. It's called a subprime mortgage, a loan to someone the bank is pretty sure won't pay it back, which raises the obvious question: why would any bank hand money to people who can't repay it? That's insane. Unless the bank never planned to keep the loan. This is the trick that broke the world. The second you signed, your bank sold your loan to someone bigger. They pocketed a fee and tossed your debt up the chain like a hot potato. They weren't lending money to be paid back. They were making loans just to sell them. And if you're only making a loan to flip it 5 minutes later, do you care whether it ever gets repaid? You don't. You just want more loans. Any loans you can get your hands on. And that's why the standards here didn't just slip. They were demolished on purpose. So where did all these loans go? To Wall Street, which had a magic trick ready. They took thousands of mortgages, the good ones and the bad ones, dumped them all into one giant blender, and blended them into a single smoothie. Then they sold that smoothie by the cup. Buy a cup, and every month a little piece of everyone's mortgage payment flows into your pocket. They called it a mortgage-backed security. Here's the pitch that made it all sell. Sure, a few of these loans are rotten, but each cup holds thousands of loans blended together. They can't all go bad at the same time, right? Spread the risk across thousands, and the bad ones just vanish into the mix. Nobody can taste a few sour berries in a smoothie made of 2,000. But there was a catch. Even after blending, the chunks at the very bottom, the worst loans, the ones most likely to go bad, were so obviously risky that nobody wanted those cups. So Wall Street did the most Wall Street thing imaginable. They scooped up a bucket of only the spoiled leftovers, blended that into its own brand new smoothie, and slapped a fresh, healthy label on it. Same garbage, new cup. That reblend has a name too, a CDO. So why did anyone smart buy this? Now stop, because this is the question that should be screaming at you. These cups were partly made of loans to people with no job and no income. So why did the smartest money on the planet, pension funds, giant banks, entire countries, line up to buy them? Were they all just stupid? No. And this is exactly how Wall Street got away with it. 3 reasons. 1. It was almost impossible to see inside. Once you blend thousands of loans into one smoothie, no ordinary buyer can taste test every single loan. So, almost nobody even tried. They trusted one thing instead, the safety grade on the label. 2. The grade was a perfect score. Who hands out that grade? A few companies called rating agencies. Their top grade is AAA, the same grade as the US government, the safest borrower there is. And these cups? Stamped AAA. To a pension fund, that's not a gamble. It's a sure thing on paper. It gets better. Pension funds are only allowed to buy ultra-safe AAA things, so the stamp didn't just let them buy, it practically ordered them to. And these AAA cups paid more than real government bonds. Same safety grade, bigger payout, free money. Of course they piled in. Your grandma's retirement fund almost certainly owned some. 3. Housing had never fallen. The whole grade rested on one belief, that home prices don't drop everywhere at once. They never had, so the math said AAA was honest. But one dirty secret held the whole thing up. Remember who pays the rating agencies? The same banks selling the smoothies. This cup is full of loans to people with no jobs, but if we don't stamp it AAA, they'll just walk down the street to the agency that will. AAA it is. Imagine a teacher who only gets paid if she gives you an A. Now ask how honest that report card is. Garbage went into the blender, AAA came out, and the whole planet bought it. Not because they were stupid, but because every signal they were trained to trust told them it was the safest thing on earth. Almost nobody looked inside the cups, but a handful of people did the hard digging anyway. Some read the actual loan paperwork. Others flew down and talked to the brokers and buyers themselves. They all reached the same conclusion. The whole thing was a house of cards. You might know them from the movie The Big Short. So they made a quiet bet against it, using something called a credit default swap. Basically, insurance that pays out if the loans collapse. Insurance on a fire they were quietly hoping would start, on a building they didn't even own. They bought that insurance cheap because everyone else still believed the magic words. Houses always go up. They were about to find out what happens when the music stops. Cheap money couldn't last forever. Interest rates ticked back up, and all those teaser rate mortgages, the ones that started tiny, suddenly reset to payments people never had a prayer of making, so they stopped paying. When you stop paying, the bank takes the house and dumps it on the market to get its money back. Now multiply that by millions of homes, all dumped for sale at once. Too many houses, not enough buyers, so prices did the one thing everyone swore they never could. They fell. Say you owed $300,000 on a house now worth $200,000. You were paying off a sandcastle the tide had already taken. Millions of people just walked away, mailed the keys back, which dumped even more houses onto the pile, which pushed prices down more. The machine that drove prices up now drove them straight into the ground. Remember the pitch, they can't all go bad at once? Well, they did. When millions of people stopped paying in the same few months, every smoothie curdled at the same time. Those safe AAA cups were suddenly full of loans nobody was paying, what bankers now call toxic assets. Overnight, the world's safest investment was worth nothing, and the biggest banks on earth were sitting on mountains of them. Now, the real danger. Nobody knew which banks were holding the toxic ones, so the banks stopped trusting each other and stopped lending to anyone. Money, which had gushed for a decade, simply stopped moving. That seize-up has a name, a credit crunch. The economy's pipes just froze solid. September 15th, 2008, Lehman Brothers, that 158-year-old bank, older than the telephone, runs out of road and files for bankruptcy, the biggest collapse in American history. And it's buried under so many of these worthless cups that everyone realizes at the exact same second. If Lehman can go under, anyone can. And then the fear hits. Stock markets crater around the globe and trillions vanish in a matter of days. This stops being a Wall Street story because it walks straight into your house. Retirement accounts cut in half. Nearly 9 million jobs vanished. People with degrees delivering pizzas, some of them in the leased BMWs they couldn't return. Families who did everything right, handing back the keys to homes they'd lived in for years. The people who never touched a blender paid the highest price of all. And the people who built the blenders, that's where this gets infuriating. The banks that lit the fire were about to go down with everyone else, so the government stepped in with your money and put the fire out. A rescue package, $700 billion taxpayer dollars, handed to the very banks that caused it. The phrase for a bank too dangerous to let fail is, fittingly, too big to fail. So the firefighters finally showed up and they handed the fire hose to the arsonists, along with the bill. And the part that still makes people furious? The bankers kept their jobs. Many kept their bonuses. The regular people lost the house, the job, the savings. So how many of the people who built this went to prison? In the whole country, basically one. One mid-level banker. Everyone else paid a fine, usually with money they had already pocketed, and walked away. Trillions gone, millions of jobs wiped out, and almost no one was ever held responsible. When the bets paid off, the winnings were private, theirs. When the bets fell apart, the losses were public, yours. Heads they win, tails you lose. Economists have a cold little phrase for it, and it's the truest thing in this whole story. Privatized profits, socialized losses. Afterward, they wrote some new rules to make sure it never happened again. Some helped, but the too big to fail banks, they didn't get broken up. They got bigger. And now, why you still can't afford a house. I promised you at the start we'd get here. After the crash, houses were dirt cheap and money was free again. So who had the cash to buy thousands of those cheap homes all at once? Not regular families. They'd just been wiped out, and the new rules made their mortgages harder to get. The big investment firms scooped them up by the block. The house stopped being the thing you live in and became the thing Wall Street rents back to you. That's the quiet ending nobody puts in the headline. You're not imagining it. A lot of people are renting from the same machine that crashed their parents. So, the whole crisis on one napkin, a subprime mortgage, a loan to someone who couldn't pay, a mortgage-backed security, thousands of those, blended and sold as safe. A AAA rating that lied about all of it. And insurance, credit default swaps, for the few who saw it coming, that's the machine. If this finally made the 2008 crash make sense, subscribe. That's the whole channel. Big money concepts drawn small. Because the crash didn't start with a villain in a mask. It started with a house, a lie everyone wanted to believe, and a machine built so that when it fell on you. They called it a once-in-a-lifetime crisis. The machine that caused it is still standing, and it's still bigger than you. So the only real question is, who's holding the house when the music stops next time?